Let's face it, the rug pull happens every time at the end of a business cycle and every time the Federal Reserve and the mainstream media deceive the public with their soft landing or no recession narratives. This causes retail investors to pile in believing we're in some kind of a new paradigm and things are different this time, and then the Wall Street pulls out and the music stops. That's how this works. What's usually followed is a combination of a severe recession and a market crash. That's why I don't trust the Fed or Wall Street one bit. But unlike the Wall Street, I don't think the Fed is actually trying to lie to us about soft landings, but the Fed is always so slow to get a grip and act and work with lagging data. So by the time they actually have concrete data to take an action, it's always too late. Right now, the unemployment rate is really low, and that's all about to change as they hold rates higher for longer. Layoffs are already happening everywhere right now, and although it's not reflected in the unemployment data yet, once that unemployment number starts to tick up, it's going to be way too late for the Federal Reserve to stop that train with rate cuts. Well, before we go any further, if you can please hit that like button below and subscribe, it will help me out a lot to keep my channel going. And before I dive into 2008 and 2000, let me quickly explain why I'm making an assumption that we're at the end of a business cycle instead of at the start of a new expansion phase since 2022 when the stock market had bottomed. I don't want to get way too technical here, but simply by reading about the 4 stages of economic cycle on Investopedia, it's clear that we're at a stage where the inflation had become way too hot and the Federal Reserve had to step in to raise the interest rate to cool the economy. This only happens after an expansionary stage where the cost of capital stays pretty low, but right now the cost of capital is very expensive and companies have been laying off a lot of people as they reassess their budget. This happens at the peak of a business cycle, and we're in this holding period at the very peak where the Federal Reserve keeps the rates high to lower the inflation. Historically, this always caused a recession afterwards, including 2008 and 2000 being the most well-known example, and each time there was a huge asset bubble at the peak of that business cycle that fueled the inflation. Soft landings just don't happen, so why should this time be any different? And that is why we need to be really careful right now. In this video, I'm going to dive into 2008 and 2000 and see what the economic data and sentiment was like right before the crash happened, and you'll be surprised to see how similar things were back then compared to today. So first, let's take a look at the period between 2007 and 2008. And this was the GFC and a hard landing of the US economy. And looking at this unemployment rate, you can clearly see that this was a hard landing when the unemployment rate went up as high as 10% in 2009. And that's significantly higher compared to the 2000 recession when it topped out at 6.3% in 2003. So now what I'm going to do is Google some articles from 2007 and see what the Federal Reserve and everybody else thought was happening. So here on Google, what I did was I set up a custom range for January 1st, 2007 to December 31st, 2008. And I went to the news tab, I typed soft landing economy. And you can see that between 2007 and 2008, there's been a lot of optimistic news articles about whether we could achieve a soft landing. Yeah, just going through these articles here, U.S. economy on track for soft landing, Dallas Fed. Jobs report confirms soft landing by CNBC. So let's take a look at this article. So according to this article, jobs report confirms soft landing as of March 9, 2007. So let's look at where the unemployment rate was on March of 2007. So as you see on this screen right here, the unemployment rate bottomed around here from December to May of 2007, and the unemployment rate was really low, just like it is today. And in March of 2007, it was at 4.4%. And as you can see, the unemployment rate doesn't start to shoot up until April and May of 2008, and it starts to really shoot up around right here. So let's take a look at where the stock market was between the spring of 2007 and 2008. This is SPX, an index fund that tracks S&P 500, and let's look at March of 2007. So when that article came out, we were right here, right towards the very top of the market. And as you see, the unemployment rate was really low all the way from here to there. And after April of 2008, it started rising. And looking at this chart right here, it has formed a head and shoulder pattern. Okay. And after the right shoulder, it fell as much as the distance between the neck and the head of this head and shoulder, creating a support and stock market started bouncing, probably due to a technical reason. And all this, while this rally was happening, the unemployment rate started shooting up. And that's when the stock market realized, oh crap, this is a hard landing. And soon as it retested the neckline, and it just plunged. And right about here, I think is when the housing market started plunging as well. When Ben Bernanke said around here that the economy is doing good and soft landing is possible, did he know that this was going to happen a few months later? No, he didn't. That's exactly my point. The Federal Reserve works with data that is lagging. Unemployment rate is a lagging indicator. And as you see, when the unemployment rate starts to go up, we're already in a recession. So going back to the CNBC article from March 9th of 2007, I want you to look at this part of the article. Ben Bernanke expected re-acceleration of growth in the second half of 2007, and they declare that this job report, while lower than many views, still contained decreased unemployment rate, a sure sign of soft landing rather than a grinding recession. That's exactly like what we have today. We have a very low unemployment rate right here, even though it started ticking up just a touch in the last few months. And Ben Bernanke and some of these economists and Wall Street people back in 2007 said the exact same thing. Because of the unemployment rate being so low, soft landing it's likely. And look what happened right after they said that. It started shooting up and they fell into a recession. And as soon as it starts to go up, it starts to really accelerate, which is what I think is going to happen in the next few months in the US economy. Now let's take a look at this article, which was from later that year in September, so end of September in 2007. U.S. economy on track for soft landing according to Dallas Fed. So this article was during the window of when the U.S. inflation pressure was easing and the economy was still seemingly doing okay. It says the latest data reinforced the impression of an economy in which growth remains moderate and inflationary pressures are likely to continue to subside. Now let's take a look at what happened around that 2000 dot-com bubble burst. So that was another significant recession, but however, because of the unemployment rate only going up to about 6% compared to 10% in the Great Financial Recession, this is technically considered a mild recession. But that didn't stop the stock market from plunging from this level all the way down here. And if you look at some of the speculative stocks like Amazon or Cisco during the dot-com bubble burst, they went down 95%. I mean, that's a significant plunge in the stock market. So I found several articles from that whole dot-com era, see from 1998 to 2001, and I had to be kind of scrappy with some of the keywords to find some of these articles. So at the time, I couldn't find any articles of Alan Greenspan just coming out to flat out say, like Ben Bernanke, we're not going to have a recession like in 2008. Maybe articles didn't exist online as much at the time, but a lot of news articles that came out around 99 and 2000 are very optimistic about the economy despite the high inflation and what the Federal Reserve was doing to fight that inflation by raising interest rates. Fed hike inspires the bulls. Outlook for 2000, there appears to be no recession in the near future. Growth is strong. Growth might slow a little bit, but the inflation will be under control. Too many people believe that there's too much money chasing too few stocks. Sounds just like today, but this is a profound misconception. Wow. And this article is from July 2000. Greenspan says new data shows economy slowing, nearing balance. What a positive word, balance. And this one is from 1999. The Federal Reserve says the economy is still strong. And this article from CNN Money came out July of 2000, right before the stock market started crashing. This article quoted Charles Payne, the head analyst at Wall Street Strategies, and he clearly thought that the Fed pausing on the interest rate hikes was bullish for the market, and that he thought the soft landing was possible and they're going to get a summer rally in the stock market. Investors at the time cheered the possibility that the slowdown coupled with other evidence might keep the Federal Reserve from raising interest rates next month. So just like today, up until a few months ago, the stock market celebrated the slowdown in our economy, thinking the Federal Reserve will no longer have to raise rates. And the market always thinks that's bullish. And if you take a look at this article written in July of 2000, they were facing a serious inflation issue just like we are today. The Federal Reserve has raised short-term rates 6 times over the past year to quell inflation pressures in the world's top economy. So looking at this Fed funds rate chart of around 2000, you can see that the Federal Reserve increased the interest rates all the way from around 4.5 all the way to 6.5 in about a year. And they were having a significant inflation issues. And the Federal Reserve held the rates steady for 6 months before things started deteriorating. And looking at this article written in October of 2000, when things are already starting to deteriorate in the stock market, this article says that economists said Friday's GDP report suggests the economy is on track for a soft landing. And as you see, this soft landing optimism came out during this period when the Federal Reserve is holding rates high and steady. Just like when a bunch of optimism came out during this period when the Federal Reserve is holding the rates high and steady for about a year in the 2007-2008 period. And just like right now when the Federal Reserve is holding rates high and steady, and given that the strength of our economy right now, including the low unemployment rate, the Federal Reserve will probably hold the rates high and steady for another 6 months, probably up to a total of 1 year, and then things will probably start to deteriorate. So as you see, this happens every time before a recession. And why should today be an exception? The economy seemed pretty strong in 2007, and the economy seemed pretty strong back in 2000, and then both times inflation was really high. The Federal Reserve had to raise interest rates to battle the inflation, just like what happened today. And today, the economy seems fine until it's not. And the Federal Reserve just cannot seem to forecast where the deterioration comes from. Every time, it was something else. Back in 2000, it was the housing market meltdown. Back in 2000, it was a dot-com bubble bursting. And what kind of disaster is going to come at us this time? Well, I don't know. But longer they hold the rates at this level, more risk there will be. And out of nowhere, something could break and we could have a severe recession. And looking at how stretched our stock market is today, there's a lot of room that this could fall when that recession comes. Well, that's it for today's video. And if you like this content, please hit that like button below and subscribe. And thanks for watching.